The unthinkable is happening. China's banks are failing, and the ripple effects could hit the U.S. next. Are we ready for the fallout? Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, China's banks are crumbling, and the question everyone's asking, is the U.S. next in line for a financial collapse? I'm going to show you the surprising correlation and why what's happening in China could be our next nightmare. Now let's head over to Bloomberg, where he picked today's story up, where I want to show you what the official government view of the economy is. And then we're going to get into the real truth of what's happening in China and why it could come to the U.S. sooner than people think. As China hits 5% GDP target, but Trump tariffs threaten further growth, the reality is there's no way that China's economy hit a 5% growth rate. This is all about the government just telling the world what actually happened instead of reporting the real truth. Because if they came out and told the world what was actually happening, what we would find out is that China's economy is squarely headed into the early stages of recession, something that's going to drag the rest of the world down with it. But even with a stimulus bump in the last quarter, annual consumption growth languished below pre-pandemic levels, property investment contracted by the most on record, and deflation persisted for a second straight year. So what we're seeing since the pandemic is the Chinese economy has slowed, and on top of that, property values continue to contract. And that's not a sign of demand, and particularly in the consumer space where deflation is taking over. So we know inside China, demand is getting worse, the economy is slowing, and the property sector, which is the lifeblood of the Chinese economy, is on the edge of collapse. And at the same time, we note that who's lent big money to these property developers? Well, it's the Chinese banks who are sitting in a stage of insolvency. And let's talk about how China's GDP data is completely fabricated. As we look at some U.S. data here, we have the real gross domestic product in red against advanced retail sales in blue, both shown on a year-over-year rate of change. And you get a very clear picture that where consumption goes, GDP falls. Now in China, we've noted that retail sales growth has continued to slow. That means there's absolutely no way that they did hit their GDP target. This is just something put out by Beijing because they don't want the world to know that their economy is slowing. The problem is, everybody actually already knows that. They estimate that about 60% of the rebound in the economy's annual growth was caused by China's policy to boost consumption and manufacturing investment. That's called stimulus, while the rest came from advanced shipments, or what we see as front-running tariffs. So China's economic growth in the fourth quarter was all about stimulus and front-running tariffs. Both things are transitory because stimulus doesn't last forever, and once tariffs come into place, well, there's no move to front-run that. But we warn that such improvement may be transitory and expect the momentum to soften in the second quarter of this year as exports slow and housing weakness drags on. And a huge problem for China, because when you're in a deflationary environment, people do not want to buy homes. When housing prices go down, people don't want to buy them as much. Now, sure, are there people that will buy them? Absolutely. But most people in China actually buy them as an investment. They're not going to buy a depreciating asset here. And once tariffs come into place, well, we're going to see a big decline in Chinese manufacturing. It's going to be felt all across the world. And let's look at the government response to this, as Chinese leaders plan to raise a budget deficit to 4% of GDP and triple the sales of special treasury bonds. Of course, the question is, who's buying all these bonds? It's the banks. And how do banks really make money? They make money through lending. The problem is that banks don't want to lend. They want to buy bonds. So China's response here is we're going to flood the economy with debt, and we're going to use that money to actually go out and stimulate the economy. Now, in the U.S., if we heard such news that the government was going to borrow massive amounts of money for stimulus, what would be the response in the bond market? Interest rates would absolutely skyrocket. Wait till you see what's happening in China, because what it's saying is their banking system is on the verge of collapse. But again, here in the U.S., the belief is that debt equals higher interest rates, but there's no historical truth to that. As we look at this chart of 10-year U.S. Treasury yields against total federal debt in red, and what do we see? That as debt goes up, interest rates, they don't go up. The long-term trend is they go down. We've seen since the pandemic a rise in rates that is likely going to be reversed in a big way at some point. But the notion that you issue debt as a government and rates go up, well, it's not true at all. The government earmarked 300 billion yuan raised from a special sovereign bond sales last year to fund the equipment upgrading consumer goods trade-in program. So you see, they stimulated the economy, and it didn't really do a whole lot. And it's a key point, because what's going on with the banks is they need people to come in there and borrow and take out new loans and pay off bad loans and get the economy turned around. The problem is that's not happening. That effort could double to 600 billion yuan this year, maybe even more than that as China's economy continues to spiral downward. Officials are also allowing special local bonds to be used by city governments to acquire unsold homes and buy back unused land in moves aimed at easing the cash crunch faced by developers and boosting land prices by reducing supply. Of course, the real issue isn't the fact that developers are sitting on this property. The real issue is their banking system has lent money to these developers. They're insolvent, so the government, in a backwards race, trying to bail out the banks here by giving money to the government and saying, look, go buy these homes, and then telling the developers, start paying back those loans. Let's keep the banks solvent here, because the next move, as you're going to see, is Beijing's going to have to bail out the banks. They've already been injecting cash into them, and what's happening in the bond market is outright shocking. As recovery is still fragile, as Chinese bond yields hit record low. Now, what does that mean? Why are interest rates going down despite the fact that Beijing is borrowing money and doing stimulus? Because again, if this happened in the US, we would not expect this response from the bond market, or at least we would not expect this response in terms of what investors would expect. Because when rates go down, it's a sign that growth and inflation expectations are falling. And what it also means from a banking perspective is there's a huge lack of demand, because if you saw a big surge in lending as rates go down, well, the Chinese economy would start to turn around. But what we're seeing from the banking system is rates in China are too high, despite the fact they're hitting new lows. But something that should be surging, that's your trading and investment accounts. Check this out. As of the close of yesterday's business, here's another trade. This one we put on January 3rd. This was a pair trade. It flagged on both of our reports on the same day. And when we see it's one of our golden signals, here you see XLE, the energy sector. We have to buy it open on January 3rd. That trade up nearly 7%. Relative to the market, if you would have bought the SPY at the same time, you'd be up a mere 0.7%. You want to beat the market. You want to get an edge. I'll show you how we do it. Every day we look at machine positioning, and we position our subscribers to buy before the machines and sell before they do, and that's how we generate such big returns. Now, maybe you want to trade momentum, and that's those technical signals. We do that too, but we run a proprietary overlay. We call that Momentum Timer Pro, and every day we run those momentum signals. We show our subscribers these are the trades to do. I even disclose my personal trades because I use these reports every day, just like our subscribers. You get the reports, the tradable signals. I give you my opinions on which trades I think you should take. I've had both reports fully back tested to validate that they work. We give you risk control levels, a weekly tracking and update on the returns. Here's the best part. We've extended the 30-day free trial. You want to start trading and making money. You want to beat the market like our subscribers are doing. Jump on those links in the description below, because one thing that's headed down is Chinese interest rates. One thing that should be headed up is your trading account. But amid all this glorious economic strength, Chinese bond yields are at record lows. Again, what is that telling us about the future of the Chinese economy? That it is headed lower and significantly lower. And despite stimulus efforts and all of this debt, the interest rates are continuing to fall. Now, compared to the US, what do we see? Interest rates going up. But at some point, this is going to come down in a big way, because wait till I show you what's going on in the lending data in China, and we compare it to what's happening here in the U.S. The recovery is tentatively sustained in a fragile mode. Policymakers need to make a stronger fiscal boost in 2025 to ensure growth stability. No, they need to do it to keep China's economy from an outright depression. That is the issue here, because when we talk about interest rates, they're a function of growth and inflation expectations. When we look at the U.S. data here, that we have real gross domestic product still in red on a year-over-year rate of change against 10-year treasury yields in blue. And you can see that when growth slows down, it's because interest rates are already on the decline, meaning lower interest rates are not a good sign for what's coming in China. It's telling us their economy is headed into an outright depression. That's going to be a massive banking crisis. Here in the U.S., we're seeing rates rise, suggesting that perhaps the U.S. economy is going to turn higher. But much of this is due to massive selling and shorting of treasuries by U.S. investors. The question is, when all of that ends, where are rates going? Well, the likely path is going to be lower. Now, let's talk about the lending market, because what we would expect is as interest rates go down, lending would surge higher. At least that's the popular belief. As China's loan market stirs at the end of first down year since 2011, as new loans extended in full year had first declined since 2011. What is that telling us? That despite the fact that interest rates are going down, the demand for lending is not going up. Now, what do we hear from central bankers around the world? That we need lower interest rates to stimulate the economy. Here in China, what do we see? Record low interest rates. What is it not doing? Stimulating the economy. What else isn't it doing? Causing people to go in and borrow. What does that tell you? That rates are too high. The worst of the plunge in demand for credit is likely over. Well, at least that's the hope as Beijing stimulus blitz kicks in. And this is a key point here because people think that, well, banks can just put rates at whatever they want and people will borrow. But banks are businesses too. So if they take some money and say, we're going to lend this out and nobody wants to come in and borrow at that rate, what does it tell you? That rates are too high. And that's exactly what's happening in China. Despite the fact that rates are at record low levels, nobody wants to borrow at that level, meaning rates are going to come down even more, and it's going to come down substantially before their economy turns around. The problem is that's going to come to America soon enough. Wait till I show you this chart. Because when we take a look at 10-year treasury yields against commercial industrial lending, this is again U.S. data, that's shown in red on a year-over-year rate of change. What we can see is slowdowns in lending are matched with declines in yields. And this makes perfect sense that if you have a slowdown in demand, that rates need to decline until demand picks up. And here you can see that started in the late 1980s and demand bottomed somewhere around early 1992 into 1993. Meanwhile, rates didn't bottom until nearly 1994. We move forward to 1999. What happens? Rates are falling as we see commercial lending peak and roll over. Next thing you know, demand for loans plunges, rates plunges as well, and you don't see a turnaround in both of them until around 2004. We see this happen again going into the global financial crisis. Rates start to decline as lending peaks out and collapses. We don't see a bottom in yields until late 2012. We see it happen again between 2014 and 16. Once again around 2019 into 2020. And look at now, we see rising rates, but look what's happening. These rising rates are not being met with demand for lending. In fact, the year-over-year rate of change is barely positive. And what this is telling us is that if U.S. lending rolls over and heads down, that rates are too high. Because if we get a crash in lending demand here going into the first part of the year, it tells us interest rates are too high and that investors are completely on the wrong side of this market. When that happens, it's going to bring the U.S. economy to its knees. A sustained turnaround is still in doubt for a country plagued by deflation and housing slump, while China's economic momentum improved in recent months on the back of Beijing's interest rate cuts. But again, interest rate cuts in China, not enough, because what did we see in the U.S. data? That rates continue to fall after the economy's bottom, and China's economy is nowhere near bottom. If we saw that, then what we would start to see is some sort of indication in their other data that consumers are coming out and spending. We see deflation start to bottom. We see housing prices perhaps bottom out without the need for stimulus. None of that is actually showing up. And financial institutions extended 18 trillion yuan of new loans in 2024, representing the first annual drop in 13 years. Aggregate financing, a broad measure of credit, also rose less than the previous year's increase, the first slowdown since 2021. And what did we see last month from U.S. consumers? They started paying down their credit card debt. Keep in mind, debt-based economies need one thing to power them, and that is new debt and lots of it. And when you start to see credit contracting, it's a dangerous sign. Medium to long-term new loans to households, a key gauge of mortgage lending activity, were just 2.25 trillion in 2024, the lowest in more than a decade. Short-term new loans to residents, usually used for shopping and investment in small businesses, came in at 473 billion yuan, the worst reading since 2008. So you can see lending demand is crashing. So any notion that the Chinese economy is bottoming out here, any thought that the stimulus is working, it's not there. What we're seeing in China's interest rate market, seeing in bond yields, is telling us the worst is yet to come. And what's going to happen if we start to see the demand for U.S. loans starts to break down? We're going to see rates here go down as well. And next thing you know, the U.S. economy is going to follow right alongside China. Businesses remain reluctant to invest, with medium to long-term new loans to companies reaching 10 trillion yuan last year, compared with 13.6 trillion the year before. That's the first slowdown in the annual pace of new credit since 2018. So again, across all aspects, we see demand for credit falling. This is a dangerous sign for China's economy. It's telling us that their banks are on the edge of outright total collapse. And policymakers will need to roll out more assertive policies to help domestic demand recover and absorb any blow to export growth from the expected U.S. tariffs. But it's not just U.S. tariffs here. The other issue is the global economy slowing down. We look to Europe. What do we see? It's in a recession. We look in other parts of the world. We see slowdowns all across the board. Even Chinese consumers aren't spending. So what we're going to see is a globally synchronized recession here. China's banks on the brink. And what we now turn to their housing market as China's home prices fall at a slower pace as stimulus talks take hold. But the key part is they just fall at a slower pace. They didn't stop. That's so all the stimulus, it's not working. All it's doing is slowing the path down, telling us that housing prices in China are going to crash right before the banks. The mounting policy support has warmed up homebuyer sentiment. However, the broader home market recovery still faces mounting challenges this year. And improvements were seen on a year-over-year basis with new home prices falling 5.73% versus 6.07% the month earlier. Used home values dropped 8.11% compared with 8.54% in November. So again, all the stimulus did was slow down the pace. And you think about in China, people actually invest in properties. They have more than one, and they use it for price appreciation. And this market, as long as prices continue to fall, people are not going to buy homes, and you're going to see more downward pressure as people are forced sellers here. It's going to put the banks in a precarious situation very quickly. And Plunging sales have raised questions over where Vanke, the big developer, can meet a wall of debt repayments this year. The firm was once seen as too big to fail due to its government backing, but Beijing has yet to signal a stance toward the property giant. Don't worry, China's going to be bailing out a lot of property developers in the not too distant future, because what we're seeing in the interest rate market in China is telling us that their economy is going to outright collapse. The growth and inflation expectations are too high. They're going to head lower. It means the bubble there is going to be popping. And the next question is, how soon before it happens here in the U.S.? And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.